Namaste to all. Welcome you all on this another webinar by your own ICI Accounting Standard Board. And today, the topic which is to be discussed is the accounting for the associates and joint ventures in the financial statements, accounting for the same. And for that, we have got two eminent panelists, CA Bhavesh M. Gondiaji, who's a chartered accountant having more than a decade's experience and is a regular faculty in the ICI's Ind AS course. And he's also done that Ind AS course too. Welcome, Bhaveshji, and thanks for sharing your knowledge on this important topic. Another panelist is another our young member, CA Ravi Kant Mirialaji, who's got more than 7 years of experience and who is also an author of a few books on the Ind AS. Welcome, Raviji, and thanks for sharing your knowledge on the subject today. And to moderate these two prominent panelists, we have got another young and dynamic chartered accountant, CA Ashish Gupta ji, who is having a good knack on the direct and indirect tax, but also loves the accounting aspects because that forms the basics for doing any taxation or any accounting. Thank you, Ashish ji, for joining and to moderate these two panelists on a very important subject.
Thank
Friends,
you.
Welcome, Ashish. Friends, last webinar we had a discussion on accounting for the subsidiaries in the consolidated and the separate financial statements. And this webinar we are having accounting for the associates and joint ventures. These consolidation, is mandatory under the Companies Act. If I talk about as per Section 129, where a company is having a subsidiary or an associate or a joint venture to mandatorily prepare the consolidated financial statements. And of course, the AS as well as the Ind AS, as what is applicable according to that, the consolidation has to be done. So I'm hoping that today's session would be very, very fruitful to all the members who have joined in. And of course, today's discussion would be available later on also at ICI TV as well as the YouTube channel of the ICI. So hoping to have a great learning session. Come over, Ashish ji.
So your voice is cracking actually.
Ashish ji,
so your voice is cracking. Shall I start? Did you allow us?
Yeah. Please.
Okay.
Ashish ji, start करें, please.
Okay, sure, sir. Thank you so much, sir. So, with this note, good evening to all. Before I start, I would like to quote one statement. Then the statement is, the secret of getting ahead is to get started. This is a very good quote. I always appreciate this quote. So I would like to thank Pramod Jain sir and the committee of ICI who have put some efforts through this webinar also. They are like initiating the young entrepreneurs or like everyone to develop and enhance their skills. So topic for the today is webinar on accounting of associates and joint ventures in financial statements. And here we will be covering AS 23, 27, Ind AS 27, 28, AS 111, Ind AS 111, and Ind AS 112. So, Sir Bhavesh sir, I would like to start with a very basic question. So the first question I would like to ask for you is, what is the criteria for classifying an entity as an associate as per Accounting Standard 23? Can you please show some light on that?
Yes. See, as and when the word has come as a criteria for classifying an entity as an associate, we have seen so far holding and subsidiary relationship. As and when we see the holding and subsidiary, the word is coming as a control. But now, as and when the relationship between one entity with the other entity, the word is coming associate, where the important criteria to identify that the another organization is an associate or not, for that the word is being used is an significant influence. Whenever one organization is having a significant influence on the other organization, we can say the relationship is that of an associate. For that, I would like to highlight some of the indicators that now how to identify that the other organization is a significant influence. For that, I would like to share some of the points. Ashish, this is PPT is visible?
Yes, sir.
So the important criteria is here is a significant influence. Now, how to identify that, how to recognize that the other organization is having significant influence, that we can identify that the other organization is having the power to participate in the financial and the operating policy decisions of the investee. But
Bhavesh sir,
yeah,
Bhavesh sir, your PPT, your screen is visible, I guess, but I guess the PPT is not opened yet.
is not open.
Yeah. Your screen is visible.
Just one sec.
Yes.
Is PPT is visible now?
No, sir.
Now,
Not, sir.
let me share once again.
Yes, sir. It is visible now.
Visible now?
Yes, yes.
Yes. So the important criteria over here is a significant influence. And how to identify that it is a significant influence is that the other organization is having a participation in the financial and the operating policy decision of the investee. A control is not required on the other organization. You are just participating in policy making and the operating policy decision of the other organization. Yes, but see, now this is a plain word which is coming: significant influence, participation, not having control. But on the upper format, we need to give certain numbers in terms of the ownership also, so that we can highlight that any organization is having a holding 20% or more of the voting power. It is presumed that the other organization is having a significant influence. It is not a thumb rule of 20%. It is not a thumb rule of 20% that any organization is having more than 20% significant influence. But on a demonstrative basis, we can say more than 20% means you must be having a participation in the policy and the operating decision of the organization. Even sometimes less than 20% of the ownership can also demonstrate you as a significant influence, provided you are taking a participation in the organization. So 20% on the upfront, 20% on the upfront considered as a significant influence always, but not always. Yes. Okay. Is it fine now? Fine. So here they have given certain evidence about the significant influence other than 20% also, like representation on the board of directors, participation in the policy making process, material transactions between the investee and the investee, interchange of the managerial person, and a provision of the essential technical information. So the key criteria is significant influence, followed with 20% or more. Along with, these are the indicators which would tell us that the other organization is having a significant influence as per Accounting Standard 23. Yes, over to you, sir.
Okay, sir. So, sir, can we say like that on the basis of this transaction? Let me, if you have a related party, so will that come under AS23 associate? If it has a significant influence, do we need to mention that also?
Yes, 20% or more, we'll consider that criteria. Along with that, we will see that the other organization is participating in the policy making process or not. If that
Okay.
is the case, because a related party, the definition of relative is given by the standard. That
Yes.
it is a key managerial person and all this thing. So key managerial person do not have this kind of 20% or more holding. They are just relative to the particular transactions. So
Okay.
here we are talking little bit broadly over and above a normal investment that a one organization is making on the other.
Okay, sir. Okay. So, okay, sir. Now, Ravikant, sir, let me ask you one question. Explain the equity method of accounting for associates and how does it differ from cost method? Can you put some light on that, sir?
Yeah, surely. See, first thing, when you say investment in associate,
Yeah.
is it in the standalone financial statements, are we asking, or is it in the consolidated financial statements? That is the first clarity we need.
Okay.
If you say it is standalone financial statements, then you are supposed to follow accounting standard 13, not accounting standard 23.
Okay.
Right. So as per accounting standard 13, an investment is going to be classified into two, that is current investment and long-term investment. And investment in associate is obviously like when you are investing 20% or more, like as Bhavesh sir told, that must be 99.999%. It must be a long-term investment. So if you are following standalone, if you're asking me the question from the standalone perspective, you are supposed to measure it at cost, subject to if there is any permanent diminution other than temporary diminution is there, then that is what cost method as per accounting standard 13. Next comes to accounting standard 23. Accounting standard 23 comes into the picture when you are preparing the consolidated financial statements. But anyhow, if a company has one single associate, even if it does not have a subsidiary company, right, that as per your section 133, 129 says, where section 129 says, if you have a subsidiary, you are supposed to prepare consolidated financial statement. Subsidiary includes an associate also. So if I have only one associate, still I have to prepare two sets of financial. One is standalone financial, the other one is consolidated financial. So when you are preparing consolidated financial statement, then you need to apply accounting standard 23. So the equity method is supposed to be followed in the consolidated financial statements. Yeah. To answer like what is equity method, right? Initially, you're going to record it at cost.
Okay.
Right? Say you spend some X money. Yeah, this is not my cost. But that cost must be including, it may be like you must have paid more than the fair value of the asset, fair value of the shares or less than that. So then you are supposed to identify what is the amount of goodwill or what is the amount of capital reserve in your payment. That is just identification. As per accounting standard 23, goodwill is not going to be showed in the face of balance sheet. Like how it happens in accounting standard 21 consolidation, we will show goodwill from arising from consolidation. But if it is arising from joint venture, arising from the accounting standard 23 associate, no, we are not going to disclose it. It is going to be part and parcel of the total cost, even the capital reserve also. But in Ind AS 28, it says capital reserve should be directly recognized in the equity, like under reserves and surplus, you're going to write capital reserve. And subsequently, whatever the profits are made by my associate, we will be taking our share of profits. Say associate made after my acquisition 100 rupees of profit. I have got 30% of stake. So 100 into 30%, 30 will be taken into my financial statement, my consolidated financial statements, saying investment in associate account debit to my consolidated P&L. I will show it on the face of consolidated P&L, generally before tax, right? Share in profits of from the investments in associates. The 30 rupees is going to be part and parcel of consolidated profit and loss statement. And one last point, suppose if the company has got, I mean, my associate company gave a dividend to me, I'm an investor.
Yeah.
Okay, out of 30 rupees of my share, maybe they must have given 10 rupees to me. But this is not going to be treated as a dividend income now in the consolidated financial statements. We'll say it is like you are already increased your investment and profits. Now you got the money back. That is like now bank account debit to investment account you are going to record. That is like realization of investment money.
Yes, yes.
That is not income because you already recorded the income, like unrealized income you recorded. It is just like realization of what was sitting in the investments account.
So this is a very good clarification, sir. Thank you. So next question to you, Bhavesh sir.
Yes.
How does AS 23 address the recognition of losses in associates?
Yes. Now see, for that, I would like to just elaborate with a small example. Like A Limited is having an associate B Limited.
Yes.
And A Limited has acquired and has become an associate by paying 1 lakh rupees. And they have got more than 20% and it is identified as an associate. Now, a B Limited is making losses. Question arises that B Limited is making losses. Then how to incorporate that losses of B Limited in the books of A Limited at the time when they prepare a consolidated financial statement? So now I assume that B Limited has made a loss of 50,000. My holding is, assume 20%. So a 10,000 rupees of loss, I will record it in the books of A Limited. So my value of investment was 1 lakh. Now it will become 90,000 because 10,000 rupees of loss I have to record. Again, they have made a loss of 10,000 next year, assume. 10,000 has came. So now B Limited is making losses only. So they have made that much of losses that my value of investment has become zero. My value of investment has become zero. So now, so this is the first part of the question, that an associate is making losses, then how to incorporate the losses in the books of A Limited, that is take your proportionate share and reduce the value of investment. But now if you do not have a value of investment and the associate is still making losses, then how to account that losses also, we will consider that part. So in that case, in the second case, I'm telling that A Limited should restrict themselves to the value of investment nil. They should not incorporate the losses after the value of investment has become zero. That would be the treatment for recognition of losses made by an associate and how it would be incorporated in the books of the A Limited. But along with that, I would like to take an comparison with the subsidiary. Like assume that instead of associate, if that would have been the subsidiary, then holding company, how they would have incorporated the losses, then they are not supposed to restrict themselves. They should continue taking the losses till the time holding subsidiary relationship is there. But that would not be the case when A Limited is having an associate is making losses. Restrict yourself to the value of investment becomes zero. After that, you are not supposed to do any provision for the losses of associate.
Okay. So this brings to a conclusion, sir. As you said earlier, if we are having only if we have not invested in that company, we are just having an influence, like we are supplying the goods to that particular entity, like we are having only influence on that. So in that case, if that firm is incurring losses, shall we put that that thing in our notes to accounts or something, that we have an associate, because it will be covered in our the definition of associate. So do we need to disclose something on that aspect? If we are having no investment, we are just
because
we are just having influence on that.
The associate, the definition of associate has been given where they are telling that you have acquired the ownership also more than 20%. So the question is coming that at the time when you are taking the losses, you need to have a holding. Otherwise, that incorporation of losses would arise in what format of number? In order to accomplish the number, you need a percentage of holding. That 22%, 25%, then only I can take the losses. and then I will be able to reduce my value of investments.
Right, sir.
Yeah, when my share is 0%,
Yeah.
I may be having significant influence when my share is 0%. 0% of loss or profit should be taken. That means nothing is going to come into my books.
So
I'm just influencing. That's it.
So
Yes.
nothing is required in notes to accounts or like anything. My basic point is, do we need to disclose it somewhere?
Yeah,
Or-
in notes to accounts, it would be an additional information that would be
Yes.
providing. But
It-
this
it would
is
come,
the
sir.
incorporation of loss would
Yes,
be
sir.
the treatment will be given in the financial statement.
Okay, right, sir. So my next question to Ravikant sir is to you. Please compare and contrast the equity method of accounting under Ind AS 28 and Accounting Standard 23. What are the main differences between these two standards?
Yeah, see, more or less equity, you are asking the equity method differences.
Yes.
More or less it is same, except like one I told you already, and I will be adding little more. See, first one, like when you are identifying the goodwill or capital reserve, in Accounting Standard 23, it is not permitted to write capital reserve in the balance sheet. It is going to be adjusted with the cost itself. But whereas in Ind AS 28,
Yes.
you are supposed to show it as a separate line item in the reserves. There is other equity. It is going to be part of other equity, reserves and surplus. And the other things like taking the share of profit or share of losses are same. But with respect to like Bhave sir told, that is as per Accounting Standard 23, Bhave sir completed. Let me tell that is going to be a small difference with respect to Ind AS 28. Ind AS 28, it is not just the example. I have an associate. I have 25% stake, or say 30% stake in one associate company. Not only that, what I did, I purchased the preference shares of that company. Could be. I have issued, I purchased the debentures of that company. Or I must have given a long-term loans and advances to other company. So you are going to knock off the losses till the entire interest in the associate. Interest in the associate in the sense, you are not like my investment in equity is going to be say 100 rupees. Maybe my investment in preference may be 50 rupees. Investment in debenture another 50. Long-term loans and advances may be some X number. Suppose put together is going to be 250. Entire 250, you have to take the losses into your account till you nullify all the numbers. That is one. At the same time, with respect to like different accounting periods, if there are any, right? Accounting Standard 23 says if the difference is maximum a period of 6 months, it is accepted. You can take it. I mean, say I'm preparing as on 31st March, investor is preparing as on 31st March balance sheet. My associate is preparing as on 30th September. So there is a gap of 6 months. So this 6 months is accepted, but you have to take care of the significant transactions or adjustments. You have to adjust the numbers to the given financial statements, and you can take the equity method. But accounting Ind AS says no, 6 months is not permitted, only 3 months are permitted. Like this, there's a small changes are there. Otherwise, overall, it's more or less same with respect to equity method.
Okay, sir. Okay, so my next question to Bhave sir.
Yes.
So please tell, how should an entity account for its interest in associates and joint ventures in its consolidated financial statement in Ind AS 20 under Ind AS 28?
Yes. Yes. Now see, earlier two questions I have answered in context to and reference to the Accounting Standard 23.
Yes.
Now the thing has come now, we have little bit switched over to the Ind AS 28. So over there, see, in Accounting Standard, we had 23 for associate and Accounting Standard 27 was there for the joint venture. But now coming toward the Ind AS 28, here we have associates and joint venture both together. So let's see how the accounting, now the thing is coming that how entity will account. So we have to see the accounting formation of associate and joint venture in the books of the holding company at the time when they prepare the consolidated financial statement. So for that, let me take up 1 or 2 PPT for the small example.
Sure, sir.
Is my PPT is visible, sir?
Yes, sir.
Yes.
It is visible.
Yeah, this is to your question number 5.
Yes, sir.
Now, see, initially recognition of the investment in an associate at its cost. Initially, when a holding company is acquiring more than 20% in any organization, that would be accounted at its cost in the separate financial statement. Now, how that movement would happen in that value of investment at the time when they prepare CFS, at the time when they prepare consolidated financial statement. In SFS, they continue to record at its cost. So now adjustment will be done as and when the time passes. So what adjustment will be done? Here, they are supposed to recognize the proportionate share of income. 3 things will come. They are supposed to recognize the proportionate share of OCA, as well as any distribution is being done, that is reduce the distribution received from an investee. So these are the 3 things that would be incorporated after recording the value of investment at its cost. See, for that I have taken one small example. Very quickly we will come through the entire part. Like on the date of acquisition, at the time when you prepare SFS, separate financial statement, when you make an investment, you will pass in journal entry, investment in associates to cash and bank. Again, I am repeating, this is in the separate financial statement. Now, as in when an associate is making a profit, then we will recognize that profit by crediting the share of profit, and we will increase the value of investment. So investment in associate account debit to share of profit or a loss. Assume that associate is distributing the dividend. If they are distributing the dividend, we will also receive the dividend. Bank or cash and account debit to investment in associates.
Yes.
So these are the 3 points which we have gathered and summarized here. For that, I have taken one small journal entries for the respective books of accounts. So now, see, initially my investment was 1 lakh. And this I have recorded in the SFS. But now, what will be the value of investment in my CFS? The summary of that the 1 lakh rupees, the original value of the investment at its cost. Then I have to account share of profit or a loss, 30,000, and dividend I have deducted. And this 1,22,500, this will be the value of investment in CFS as per Ind AS 28, 1,22,500. This is the way Ind AS 28 is addressing to record the value of investment of associate in CFS.
Okay, sir. So, nice explanation, sir. My next question to Ravi sir is to you. Please discuss the concept of significant influence in the context of Ind AS 28.
So significant influence, see, that arises, actually there is no big difference between accounting standard 23 to Ind AS 28 with respect to the word significant influence.
Okay.
Yeah, see, significant influence, it says that is power to participate in the financial and our operating policies. I mean, Ind AS says and financial and operating policies of the entity. So how do you get the power to participation? That they say like it can arise out of the 3 things. One is from the ownership. Like already Bhavesh sir explained, yes, in the as part of ownership, it is like it is presumed that if you have 20 or more than 20%, we assume that you have got a significant influence and you are the investor, other parties an associate. And it is not like there is, I mean, thumb rule or something. It is like, if you have more than 20, if it is 20 or more than, it is for sure it is an associate, not necessary. If you have a contradictory information, even though you have 25%, you never had participation in the policy making or financial decision making, then you are not going to be associate. At the same time, if you have less than 20% also, if you are able to prove that, yes, I am actually participating in the financial policy decision making, then you are going to become investor, other parties, and associate company. And the second route is like a statute, that is as per the law. Like say this is here, like one of the question you asked sometime before, like when say example Government of India or RBI example, RBI will have some influence on the banking system. At the same time, Government of India, even though my stake may be less than 20% or whatever it is, on the PSU, public sector entities, and some entities, Government of India will be having always significant influence. This is arising not because of the stake, but this is arising because of the law prevailing. Okay, and the third thing what can come, it is because of the arrangement or agreement. I may be having only 5% or 10%, but I am providing something very critical and important software, or critical, and I mean I have a huge transactions, say 90% of your products are bought by me, or something like that. If there is an arrangement, then also there can be a significant influence. So more or less it is, I don't differentiate, like there is a great difference between accounting standard 23 to Ind AS 28 with respect to the word significant influence.
Okay. Right, sir, right. Okay, Bhavesh sir, now next question to you is please.
Yes.
Sir, please explain the exemptions for investment entities under Ind AS 28.
Yes. See, now coming towards an associate, coming towards an subsidiaries. See, all people are making investment in some other organization with certain intention. Because see, when I am acquiring more than 50%, my intention is within their operation, is within their growth. But the investment companies, like we have a venture capital organization, mutual fund, see, many of the time they are also holding certain percentage of the equity, but their intention is not to generate a stable income. Again, I am repeating, their intention is not to generate a stable return or an income, but their intention is to have a capital appreciation, and that too also in a very shorter period of time. So the intention behind making investment by the investment company is not to get adhere to their operating decisions, is not get to adhere their operating policies. So there are certain investment company on a broader view, can I say venture capital organization, mutual funds, unit trust, or similar entities are being exempted for application of the Ind AS 28 with an intention, because they are making investment decision to form a portfolio, not for the operating policy. So they form a portfolio to generate a higher capital appreciation, and that portfolio will also find an exit strategy. And here, when we form subsidiary, when we form associate, our intention is not to get an exit strategy, but to expand, to form a greater, higher operating policy decisions. So these are the investment company who are not having a much impression of generating a stable income, only for the purpose of creating a portfolio for a capital appreciation, are being exempted under Ind AS 28. Over to you, Ashish sir.
So, sir, very good example, I guess, with the venture capitalist fund, like the startups, we can see on the Shark Tanks. So basically, what they are putting is, like, if they are venture capitalist fund, they are forming a venture capitalist company. So basically, they are exempt in that case, right?
Yeah, only with the investment purpose.
Only with because their purpose is only
long-term strategy also.
Right, sir, right. So my next question to Ravikant sir is, what is the distinction between the joint operations and joint ventures in context of Ind AS 111?
Yeah, a good one. See, joint operation, joint venture. When it comes to joint operation, a small example, like say, I have some work, I mean, I have some, my plant and machinery, my equipment, my people, everything is there. I wanted to do, I mean, you also have got some setup already is there. Understanding is like, say, 50% or 60% of work will be done by me, 50%, 60% of work but done by you. Both of us together are going to serve the purpose. I mean, some order has come, both of us together will do the job. And so now here, what is happening? Say here, You are doing your job, I'm doing my job. Total revenue is going to be shared between us as per the agreement. Right here, you have your own assets in your books. Correct. Now, I have my own assets in my books. Right here, this is kind of joint operation. And another way also it can happen. Like say, I have one building, say hotel, one building. You have people to operate it. Otherwise, both of us have two buildings together. We are going to do the business. Now here, in this case, you have rights over your particular fixed asset. I have rights over my particular fixed asset. Yes. Suppose example, for that building there is some liability. That liability you are responsible. For my liability I am responsible. But
Yes.
we are doing the business together.
Yes.
Now here it's not like you're opening an entity. One company I'm opening, I have got 30% stake. So my interest is not on the net assets or net liability. In case of joint operation, my interest is with respect to specific asset, specific liability. If I give a balance sheet of joint operation, you can tell this is related to Ashish, this is related to Bhavesh, this is related to Ravikant. We can very clearly specify. Then it is called joint operation. If it is a joint venture or joint entity, whatever you say, right? Here you are forming an entity, like say company. In case of a company, I have got 20%, but I cannot say this 20% of this asset is mine. No, you have got your interest is on the net assets, not with respect to specific asset or specific liability. That is the difference between operations and venture.
Very nice elaboration, sir.
Correct.
Sir, my next question to Bhavesh sir is, it's an
Yes.
example. I would like to state that. Let's
Yes.
say a company, AB Limited, holds investment in subsidiary and associates. In its separate financial statements, AB Limited want to elect its accounts in its investment in subsidiary at cost and the investment in associates as financial assets at fair value through profit or loss in accordance with Ind AS 109. Ind AS 109 financial instruments. Whether AB Limited can carry investment in subsidiary at cost and investment in associates in accordance with Ind AS 109 in its separate financial statements.
Okay. So in the entire example, no, I would like to extract one important word in that entire example is that wants to elect. The word is coming wants to elect. That means they want to select that for one criteria, that is for one subsidiary, can I go with cost?
Yes.
Other is for associate. Can I go with the FVTPL, that is a fair value through PNL in accordance with the 109? So as and when the word elect is coming, that means we would like to give them the choice. That do you have a choice for selecting a particular way of valuation for subsidiary as well as a particular way for valuation of associates? Then the answer to this question is yes. You may go with subsidiary at cost. You may go with associate at FVTPL, provided the criteria which are being mentioned under 109 for the financial instrument are being fulfilled. Number one. And number two, that if you are recording in accordance with 109 in the separate financial statement, then in CFS, I would like to add one thing, that in CFS, you are also supposed to continue with compliance of 109. Then you can't switch over in the CFS that yes, I will go at cost over there and fair value over here. So in both the financial statement, you are supposed to follow the same way as you are following in the SFS. But the choice is available. The election is available for you to select to go for cost or to go with 109, provided the criteria of 109 is fulfilled for financial instrument. Over to you, Ashish sir.
Okay, sir. So my next question is to Ravikant sir. So it's again an example. Okay. So company A Limited has equity investment in a limited liability partnership. Company A Limited has joint control over LLP and has assessed that the investment in LLP is a joint venture. How investment in LLP can be accounted for in the separate financial statements of a company A Limited? Number two, whether the profit share from LLP be adjusted to the carrying amount of the investment in LLP in the separate financial statements of a company of A Limited?
Yeah, see, this is a really good one. I'll tell you the accounting at the same time. What is the practice which is happening? Okay, I mean some financials. If you look at, see, whenever you say it is like accounting in the standalone financial statements. Yeah, in case of standalone financial statements, as I already told you, like investment in subsidiary or investment in associate or investment in joint venture, everything will fall under accounting standard 13. Yes, under accounting standard 13, it is going to be a long-term investment. Yeah, the rules of long-term investment, it is going to be measured at cost and it may be reduced for any diminution other than in temporary nature. That's it. And it's not, we are not going to add any profits or losses of this. It may be LLP or it may be a company, it may be a partnership firm. No, you cannot take your share of profits in the standalone financial statements of investor. Right. The point again. See, if it is a partnership firm or LLP, unless until a declaration or if it is yours. See, one simple point. When you want to record the income, like dividend income, you call whatever your share of profit, you call it. Whether investor has got the right to receive. Is it right to receive is established. The minute you say right to receive established, yes, please take it as an, dividend receivable or profit share in profit receivable account debit to income. Right. If you cannot establish the right to receive of the money from the LLP or partnership firm, you are not supposed to record the income. This is what very clearly said in the standard accounting standard 9 says. At the same time, guidance note on schedule 1 and schedule 2. Schedule 3, division 1, division 2. In both the places, it's very clearly given under paragraph 9.3 something. It's given very clearly. The share of profits can be taken into financial statements only when the right to receive is established. Some of the practices are happening, without establishing whether the right to receive is there or not, and they're accounting for the income. That may not be a correct practice as per the standards. It has to be at cost.
Okay, sir. So my next question is to Bhavesh, sir.
Yes.
Sir, it's an example again. AB Limited and BC Limited forms a company PQR Limited to develop and market specialized medicinal products. AB Limited is responsible for and has the unilateral ability to make all the decisions relating to developing the medicinal products and obtaining the regulatory approvals. Once approvals are in place, BC Limited will manufacture and market the medicinal products and will have a unilateral ability to make all the decisions about the manufacturing and marketing. It is determined that all the activities developing the medicines and obtaining the regulatory approval as well as the manufacturing and marketing the medicinal products are relevant activities. Whether AB Limited and BC Limited have joint control over PQR Limited?
Okay. Again, illustrative questions in front of us.
Yes, sir.
Let me just summarize also this, like AB and BC Limited are there.
Yes.
And they would like to develop some two activities with the formation of the PQR Limited.
Yes.
And their two activities, in that two activities, there is one important element which I would like to extract once again, that you have used the word, Ashish sir, is a unilateral ability to make all decisions.
Yes.
That means two activities are there. Each activity is being shared by AB Limited and BC Limited. And in that, performing that activities, both has a unilateral ability to decide. That means they have got 100% power to execute that activity.
Yes.
So question in front of us is that whether both this activity in this operation are your relevant activities, number one. And number two, performing this type of activities under this kind of formation, whether AB and BC Limited are having joint control over PQR Limited or not. So
Yes.
for two questions we are supposed to answer, one for the relevant activities and the other is a joint control. Now, for that, again, I would like to highlight something. Yeah, is this visible?
Yes, sir.
So now, see, as and when the word, we are supposed to identify that joint control is there or not. In order to establish that joint control is there, two parameters are very important here. These are the two parameters for establishing joint control. The number one is a collective control. No single party enjoys full control. If that is the case, we can say there is no joint control. Second characteristics is unanimous decision. That means there has to be a unanimous consent of all the parties having joint control on the decision of the arrangement. When these two criteria are fulfilled, you can say they are having a joint control. So now we are supposed to ask to AB Limited and BC Limited, are you fulfilling this criteria? Is there a collective control? But as you have told in the question, there is a unilateral ability to make all decisions. That means there is no collective control is there and unanimous decisions are there. So this would not be the case of joint control. This would not be the case of joint control, and relevant examples of the relevant activities which they've asked. Like those two, one is taking care of the marketing, other is taking care of the manufacturing. Let it be on the standalone. Those activities are relevant or not, relevant activities as per the standard. Then I've given one illustrative list of which all are the activities would fall under the relevant part. Is your selling and purchasing of goods, establishing, operating and the capital decision, appointing of investees KMP, managing financial assets during their lifetime, selecting, acquiring, disposing of asset, research and development, determining a funding structure for obtaining funding. So considering this list, AB and BC Limited are being assigned one activity. We can say yes, that is relevant activities. But the criteria of the joint control are not being fulfilled by them because they are independently 100% making decision. There is not an involvement of the other party in the entire organization. Hence, relevant activities are there, but joint control is not there on the basis of this criteria presented to you. Okay. Over to you, Ashish sir.
Sir, considering this example, I would like to ask one question.
Yes.
Considering these facts, as discussed in this question, can AB and BC Limited enter in a partnership agreement? If a partnership agreement is entered, then how will they claim and allocate expenses, if any, to such gains?
You see, now, as and when the partnership is coming, a simple definition would come into our picture that no principal and agent relationship. One party is there, other party can do on their own, yes, and other party will accept also. Yes. So if that is the situation would go, see, in order to enter into the partnership, I don't think you need any approval. That is fine altogether. And you may agree your ratio and everything. That is depend upon orally or a written format of partnership can also be executed. But at the time of coming to this joint control, it would not give a call.
Okay, sir. Very nice, sir. Thank you. Sir, my next question is to Ravikant, sir. So the question is, entity A, an Indian company, and entity B, an overseas entity, are partners in AB partnership firm. The firm is domiciled in a foreign country. Each entity has a 50% share in a firm. Whether AB partnership firm is a joint operation or a joint venture. Number two question is whether the response will change if AB is a limited LLP instead of partnership firm.
Yeah, see, I mean, just to repeat, you are saying like A is one partner, B is another partner. Okay, one is Indian company, another one is a partner company, I mean, outside Indian company. They're opening a new one firm called AB firm.
Yes.
Right, with 50-50% stake.
Yes, sir.
Yeah, assume like, I mean, there, see here, 50-50% stake in the sense, if you want to take any decision, obviously it requires more than 50% I mean, more than 50% is required. So it is implicit. It is not whether you, I mean, see, generally like joint control, when you want to have, you need to have a separate agreement saying that you need to have unanimous control. right? Here, even though you don't have a separate agreement for joint control, it is implicit that when I have 50, you have 50%, right? Without both of us agreeing, no important decision, no relevant activity is going to take place. So it is going to be treated as a joint control is there between A and B over AB company, AB firm, right? And see again, the next question is it a joint venture or joint operation?
Yes.
So whether it's a joint venture or joint operation, like I told you, your rights and obligation is with respect to the assets and liabilities, or is it rights and obligation with respect to net assets of the entity?
Yes.
Yeah. So how is your understanding? How is that business is happening? So that you need to look at the terms and conditions of the contract. Then we can come to a conclusion. So I think that's it, sir.
Okay, sir. So, the next was whether the response will change if AB is a LLP instead of partnership.
See, if it is a LLP or if it is a partnership firm, actually our standard to wellness standard is applicable for every kind of entity.
Right.
So it is applicable, same thing. There won't be any change.
Sure, sir. Okay, sir. Okay, my next question is to Bhavesh, sir. So what is the accounting treatment when an entity enters in a transaction with a joint operation in which it is a joint operator, such as a sale or contribution of assets?
Okay. The question is small, but speaking about an accounting treatment.
Yes.
Now, at the time when the accounting treatment comes to without numericals, it would be difficult for us to explain what would be the accounting treatment.
Okay.
So let me take once again one small example.
Sure, sir.
Yeah, on a theoretical note, accounting for sale of asset to a joint operation by a joint operator. Like a joint operator is making a transaction with the joint operation, then how the treatment or a profit or a loss, purchase or a sale, that would be accounted in the books. Let me take one small example. Like, is the screen is visible?
Yes, sir.
Okay. A Limited is one of the parties to a joint operation holding 60% interest in joint operation, and balance 40% is belonging to the another joint operator. A Limited has contributed an asset held by it to the joint operation for the activities to be conducted in the joint operation. The carrying value of the asset sold is 100 and the asset was actually sold for 80. So that means there is a loss of 20. So in the books of accounts, my value was 100 and my sale value was 80. So I got a loss of 20. I hope, Ashish sir, your question is this only?
Yes, sir.
About how to record these transactions and how to account this loss of 20. So how should A Limited account for the sale of asset to the joint operation in its books? How we should account this 20 rupees of loss? That is the question in front of us.
Yes.
Response to that, A Limited should record the loss on the transaction only to the extent of the other party's interest. Other party means the other joint operator that we had. Our interest was 60%. So I had a joint operator, the other joint operator was having a share of 40%. So I need to take 40% of 20, that will be coming.
8.
I hope I'm, is it 60% or a 40%? Sorry, 8. Yes, correct. 8 rupees of loss. So the total loss is INR 20 rupees. A Limited should record the loss on sale to the extent of 8 rupees, which is this. 20 into 40%, which is the loss pertaining to the interest of the other party, and the loss of 12 shall not be recognized. And that would be treated as an unrealized loss. So in this case, A Limited is our joint operator, is selling an asset to the joint venture, and is suffering a loss. Question in front of us, how to record that loss. He is not supposed to record his share of loss. He is supposed to account the share of loss pertaining to the other venturer. That is your 8 rupees in our example.
Very nice elaborated, sir, with example. I think it was not possible if you haven't framed this example. So, thank you, sir. My next question is to Ravikant, sir.
Yes, sir.
So, what are the major differences between Ind AS 111 and joint agreement and AS 27 financial reporting of interest in joint ventures?
Yeah, see, accounting standard 27, if it is a jointly controlled entity, accounting standard 27, joint arrangement will be having like 3 topics. One is joint controlled asset, joint controlled operations. Next one is jointly controlled entity. If it is a jointly controlled entity, AS 27 says you need to follow proportionate consolidation method. Yeah, so when it comes to proportionate consolidation method, say I have 50% stake. So I'll take the balance sheet of the jointly controlled entity, 50% of all the assets, 50% of all the liabilities, like line by line consolidation is going to take place. Wherein you are going to recognize the goodwill, capital reserve, obviously proportionate 50% of the goodwill comes into the consolidated balance sheet. Capital reserve also will come in. Right, that is proportionate consolidation method as per accounting standard 27. Yeah, but when it comes to, same investment, say example, if you go to Ind AS 111, yeah, Ind AS 111, if it is a joint venture, if it is a joint venture, that refers to the accounting treatment as per Ind AS 28. Ind AS 111 will say, if you want to, how do you account for the interest in the joint venture? It says, it will give a reference of Ind AS 28. So if you go to Ind AS 28, Ind AS 28 is applicable for investment in associate as well as investment in joint venture. So that says you are supposed to follow equity method. That is what we have discussed so far, initially recognized at cost. But here, you will not be recognizing the goodwill. In case of proportionate consolidation, you will be recognizing the goodwill. But Ind AS 28 may, no, goodwill is going to appear on the face of balance sheet. Yeah, in nutshell, Ind AS equity method you are going to follow, accounting standard proportionate consolidation method you are going to follow. And accounting standard, goodwill, proportionate amount of goodwill will appear on the face of balance sheet. In Ind AS, goodwill is going to be part and parcel of the cost of investment. It is not going to be presented separately on the face of balance sheet.
Okay, sir. So my next question is to Bhavesh, sir.
Yes.
So the question is whether the restriction on transfer of funds from the investee to entity precludes the existence of significant influence of entity over the investee.
Yes, Ashish sir, is a very small question and one-liner you have asked. Yeah, the answer to this question, no, it is a yes. We are supposed to exclude because that is specifically told under the accounting standard 23 as well as the Ind AS that when there is a restriction on the transfer of funds, no, when you are not able to execute a particular financial transaction and there is a restriction that would preclude the significant influence, and this would not be considered as a part of significant influence. Very small question and one-liner this is.
Okay, sir. Okay. So my next question is to Ravi, sir. Whether a company is required to disclose the facts that the financial statements prepared by them are separate financial statements?
Yes, if it is, if you are preparing 2 sets of financial, one is standalone and consolidation. For a specific identification purpose, you need to say standalone financial statements and consolidated financial statement. Again,
Okay.
this is also, yeah, you need to do if you are preparing two sets.
Okay, right.
Otherwise, obviously, financial statements, if you have only one, then there's nothing to, if you say financial statement, that's more.
That means a separate financial, right, sir. Okay, so the next question is to Bhavesh, sir.
Yes, sir.
How should the transaction between the reporting entity and its associate or joint ventures be eliminated at the time of applying equity method of consolidation?
Yes, see now, earlier in the question, we have seen the accounting and we have seen how the share of loss has been accounted in their respective books of accounts. Now coming to the CFS, when you combine both set of books of accounts, see actually the transaction has not taken and sell. It has been just gone from one hand to the other hand. But in both the case, our own people are there. That is why the need was arising to record the transaction in the SFS. But when you come down to the CFS, following the equity method of consolidation, then that unrealized portion should be eliminated or not. Like in the consolidated financial statement, like holding and subsidiary, a very user-friendly terminology was being used as an upstream or a downstream transaction. When a holding is making sale or a purchase with subsidiary is making sale or purchase with holding, then at the time of preparing CFS, let them record in the respective books of account sale and purchase. But when you combine, should I eliminate? In the same terminology, I have to see in the case of a joint operation also, we have two joint operators doing a transaction with the joint venture, following the equity method of accounting, then that transaction should be eliminated or not. That is the question in front of us. Let me just highlight. In short, I would say this is a treatment of elimination. It is nothing but removing an unrealized profit.
Yes.
Whether I should remove that unrealized profit from CFS following the equity method of accounting, then that has to be eliminated. And this is a popular word which we are using in the holding and subsidiary. The same terminology will be used as upstream and the downstream. Such loss or a gain in the financial statement only. Now, how much to be removed? Only to the extent of unrelated investors' interest in the associates or a joint venture. How we have removed that 12 rupees? In the similar pattern that would go in the CFS, and we are supposed to eliminate that other party's share of interest for unrealized profit or a loss. That is, an elimination will be followed. In the nutshell, elimination of that unrealized profit has to be done.
So basically, if we consider example, that is 40%, sir, or 60%?
The other part.
The other part was, I guess, the 40%, no?
Yeah, sorry, 40%.
Yes, sir. Okay,
and
sir.
that we are supposed to reduce from the value of investment.
Right, sir.
That we are supposed to reduce from the value of investment.
Right, sir. So my next question is to Ravikant, sir.
Yes, sir.
Okay. So the question is, how should goodwill oblique capital reserves be computed on step increase in an existing associate or joint venture? Is there a need for remeasurement of existing ownership interest at the time of increase?
See, goodwill or capital reserve, how to calculate is what very clearly given in the both accounting standard and Ind AS. Right. That is at the initial acquisition time. Yeah. What you are trying to say is step acquisition. Yeah. Can I use the whiteboard here? Just a sec. Yeah. Can you? Okay. Yeah. Can you see that?
Yes, sir.
Say, see goodwill calculate. Yeah. If I say goodwill calculation. Yeah. If I put a goodwill calculation, very simple it is. It is going to be like your cost of investment. Your cost of investment is equal to 100. Say I have spent some for 30% stake, I spent 100 rupees. Correct. And say example, let me go to accounting standard 23. Yeah. If the question is right now you have got 30% stake. This is the existing stake. This is the existing stake. Now you are saying step acquisition. Next, already existing associate, you are getting another 10% stake. So you are going to, you are going to have 40% stake, right? And to say now, point is, with respect to 30%, you already calculated either goodwill or capital reserve, you have identified, it is already done. Now the question with respect to 10%, what are we supposed to do? I mean, for the next investment, the next step investment, what am I supposed to do? Right. For this, there is no guidance straight away in the accounting standard 23 and Ind AS 28. There is no straight information. What are we supposed to do in case of step acquisition? Right. So then when there is no clear guidance, automatically in accounting standard, as there is no clear guidance, it automatically leads to accounting policy choice. Right. So in case of this 10%, say example, I will just take it out. For the 10%, if you have spent 100 rupees, and next let me elaborate little more. Say this you bought it in 2021, and this you bought it in 2022. Correct. After a year, you purchase another 10%. Right? Why can't we can calculate it? What is the goodwill or capital reserve to the extent of 10%? Right. So to the extent of 10% means we will say, right, cost of investment for 10% is equal to 100. And what is the proportionate? That is 10% of equity. 10% of equity of the associate on the date of acquisition. On 10% acquisition, what is the equity? That is assets minus liabilities net worth. Into 10% you take it. Yes, that may say example that comes to 90. Just example. This 10 rupees is going to be my goodwill, which is part and parcel of your 100. Goodwill, anyhow, I already told you, goodwill is not going to be showed separately. Goodwill is going to be part and parcel of investment. I can write a simple journal entry, something like this. Yeah, investment in associate, I will say account debit 100 rupees. We will write like including goodwill of 10 rupees, right? To whatever you have invested, that is to cash or to bank, whatever it is, the consideration is going to be 100. Like this is. But in Ind AS also on the face of the standard, there is no clear, guidance. But if you see interpretation committees, some agenda discussion, they had given some two choices. I mean, they had come out with like accumulated cost or deemed cost of fair market value. It is given, but yes, that is not part of the standard as of now. It is part of discussion. Yeah, there is light discussion is given, but there also it leads to accounting policy choice.
Right, sir.
Yes, sir.
So nice example, sir. So my next question is to Bhavesh, sir.
Yes, sir.
So what are the major differences between Ind AS 28, investment in associates and joint ventures, and Accounting Standard 23, issued in 2001, accounting for investment in associates in consolidated financial statements?
Yes, the differences between the accounting Ind AS 28, which is an associates and joint venture altogether, and
Yes.
there is an AS 23, which was there only for investment in associates. Because AS 23 and 27 both were separate, one for associate and one for joint venture. Here we have combined together as an Ind AS 28. So for that, let me just present it once. Is it visible?
Yes, sir.
Yeah. See, now coming towards an associate, when we come to the Indian GAAP, it is an AS 23. When we come to the Ind AS, it is 28. For associate, we have equity accounting. In the Ind AS also, we have equity accounting. No major difference. Similarly, it is same. And here, no MI. MI stands for minority interest. As we used to have in the holding and subsidiary relationship, the other party, like we hold 60%, then 40% we call it as minority interest under accounting standard. But under Ind AS, we call it as that as a non-controlling interest, that is your NCI. This is about an associate. Coming toward the joint venture, under Indian GAAP, we had called accounting standard 27. But under Ind AS, that is accounted under Ind AS 28 only. So for associate and joint venture, this is one and the same. But for associate and the joint venture, under the Indian GAAP, both are different. But there is a major difference here. One is that here we follow proportionate accounting and here we follow equity accounting. The equity accounting here, both are same. Here there is a associate, we had equity accounting, but for the joint venture, it is in proportionate accounting. Proportionate accounting means if you have a share of 40% in the joint venture, all assets and the liabilities to the extent of 40%, you will incorporate in your consolidated financial statement. Again, there is no concept of MI here, that is a minority interest, as well as there is no concept of NCI in the Ind AS. This is the major difference between associate and the joint venture amongst Indian GAAPs and Ind AS.
Very well drafted, sir. Table, I must appreciate, must acknowledge that. Thank you very much. Sir, my next question is to Ravikant, sir.
Yes.
Sir, what are the disclosure requirements for the interest in joint ventures under Accounting Standard 27?
Yeah, there are few. I mean, let me share. I made a small presentation, small one. I mean, can you see that?
Yes, sir. It is
Yes,
visible.
Yeah. See, this is with respect to Accounting Standard 27. That is what your question, correct? Right? Yeah. So you are supposed to disclose. These are the few things. Yeah.
Yes,
List of all the joint ventures and description of interest. Yeah. What are the joint ventures you have? But yes, obviously, all the joint ventures list you are supposed to give. Description of interest in the significant joint ventures. Yes. Yeah, major joint ventures, you just describe what is the business is into. I mean, how big is that company and etc. information. Anyhow, accounting part we already discussed. Accounting, as per accounting standard, it is equity. I mean, as per accounting standard 27, proportionate. Just now, Bhavesh sir explained that is proportionate consolidation method, and as per the Ind AS, it is equity method. Right. At the same time, if you have got any aggregate amount of the total, this is a disclosure purpose, just disclosure purpose, nothing to do with your accounting.
Yes, sir.
Right. Contain total amount of the contingent liabilities and commitments towards it is a between you two people, that is venturer and venture. And if it is a jointly controlled entity, then you are supposed to disclose little more information in addition to the above, that is proportionate of ownership. I mean, what is your percentage? Is it 40%, 50%? And what is the company? I mean, where is the joint control entity and where it is located? That is country of origin of the joint control entity also you are supposed to describe. And at the same time, you have taken the total proportionate consolidation method you followed. So what is the aggregate amount of assets, liabilities, income and expenses of the joint control entity you just described? You must have already taken into your 40%. Say 100 rupees is the assets. You took 40% already into your consolidated financial statement. Say that the assets of the joint controlled entity is equal to 100. And we have accounted for 40 into the consolidated financial statements. Yeah, this is the, I mean, some small disclosure requirement as per accounting standard 27. This is the minimum thing what they are expecting.
Right.
So to describe it more, you can obviously elaborate much more.
Right.
Yes, sir.
So my next question is to Bhavesh, sir. Sir, please discuss the circumstances under which an entity may not apply the equity method to account for investment in an associate under Ind AS 28.
Yes, now, as and when the word equity method is coming, they are talking about an accounting treatment.
Yes, sir.
About a formation of the accounting treatment in the consolidated financial statement, for which they are telling that who will be the organization to whom this would not apply.
Yes, sir.
This would not apply. So number one in that is that, like, you have made an investment for the purpose of disposal, in the near future. If you have acquired the holding more than 20%, but you have an intention to sell it with the near future, then to those organizations, this equity method would not be applicable. As we have seen from the investment perspective, say like your near future is to just sell it, then the equity formation would not arise. And number two was you have a restriction on the transfer of the funds over the investing. This point also we have covered in the earlier case. Over there also, in this kind of organization, this equity method would not apply, even if they are under the purview of Ind AS 28. Over to you, sir.
Okay, sir. So my next question is to Ravi, sir.
Yes, sir.
So what are the disclosure requirements under what are the disclosure requirements for the investment in associates under AS 23?
Yeah, see, I think you were able to see the screen.
Yes, sir.
Yes, sir.
See, with respect to accounting standard 23, yes, that is investment in associates. Right. If it is right, you are supposed to classify it as a long-term investment. Yeah. Amount as per account, I mean, consolidated financial statements may, it is going to be equity method may, whatever you have derived. That number will be presented. But again, one more point we should say, under the investments, long-term investments, under the long-term investments, you should say investment in associates. Like say,
Right.
in case of loans, you will write secured, unsecured, and like that, if you give information here also, investments, long-term investments, investment in associates, you will be writing one information. And next point number 2, investor share of profit. That should be disclosed separately in the consolidated CP&L, consolidated profit and loss statement. Yeah. I mean, on the face of the, not in the note or anywhere, it is on the face of the profit and loss statement, just before the profit, I mean, before the tax expenditure. I mean, before tax expenditure, you should write our share of profit or loss. Why should I write after the profit or before, I mean, after the tax or before tax? As per Ind AS, if you say again. Yeah, that is not very clearly discussed as per accounting standard 22, but as per in Ind AS 28, it comes to, you need to recognize deferred tax liability with respect to the share of profits of taking from the associate also you are supposed to consider. So you have to take it before the tax expenditure, then consider the tax expenditure under Ind AS 28. Right. Here also obviously we'll be doing before the tax expenditure. And the third point, it comes to name of the associates where reporting dates are different. Yes, as we were discussing, like my balance sheet date is 31st March. My associate balance sheet date is say 30th June, right? And so under that circumstance, still you have a right to consider. It is allowed by the standard. 6 months gap is allowed actually. So you will be taking the financial statements of the associate dated 30th 6 as it is, and you will be following equity method. But you will be making some adjustments. If there is a major transactions, your profit and loss may be adjusted to that extent. Under that information, that means your balance sheet date and the associate balance sheet date are not matching, then this point will arise. Otherwise, this point will not come. That is the name of associates where reporting dates are different and the time gap in between the two reporting, that's 3 months or maximum 6 months to allow, so that information to be given. Right, at the same time, if accounting policies are dissimilar, yeah, see, that is when you're preparing the consolidated financial statement, we'll try to ensure the uniform accounting policies. Yeah, and there is a provision in accounting standard 23. There is a provision if there is dissimilar accounting policies are there, but you are supposed to adjust. I mean, you are not supposed to take the profit of the associate as it is. To ensure the uniform accounting policies, you have to make adjustments, and adjusted profit and loss, we have to take our share. And if it is impracticable to make such adjustment, okay, then what is the fact? Why is that impracticable? Because of what reason you are not able to make such adjustments? You need to disclose. And one more small point, as usual, this will be applicable for every investment, not only for investment in associate or joint venture. Obviously, how many number of shares and what is the percentage stake in so and so entity? Is it equity instrument or is it preference share investment? What kind of investment is it? That has to be given very clearly in the notes to financial statements.
Yes, sir. Very well elaborated, sir. So my next question is to Bhavesh, sir.
Yes.
So please explain the disclosure requirements for interest in associates and joint ventures in an entity's separate financial statements under Ind AS 112.
Yes, now extracting from your question, no, the things are coming from now Ind AS 112. 112 is a requirement of the separate financial statement.
Yes.
Now see, if we look at the Reliance Industries, no, they will be having in 2-digit or a 3-digit associates. They must be having that much of list of joint venture also. So in the balance sheet, so we see number. In the, at least in the schedule, you can see the name and the amount which are appearing. Now let's talk about in the notes to accounts. For each kind of associates, for each kind of joint venture, what disclosure requirements that you need to follow in the books of Reliance Industry when they are preparing separate financial statement. Again, I am repeating, this question is for SFS and it is not for a consolidated financial statement. Let me take one slide for that. So a list of significant investment in subsidiaries, joint venture and associates. What details you are supposed to provide? Like you need to provide a name, principal place of business, along with the incorporation company and the ownership. What method of accounting that you have followed? And the other facts also you may provide it. That financial statement, list of significant investment, name, principal, proportion of the ownership interest held, that will be in terms of percentage, and the method used for following the accounting. See here, the method used for following accounting, we are talking about an SFS. And at the time when you come down to the SFS, no, in the earlier one of the question, we have seen that you have a choice to record it at cost, as well as you have asked about FVTPL also.
Yes.
That was your under 109.
Yes.
So here, this is entirely the requirement of the SFS and not the CFS, because under CFS, you have an equity method of accounting.
Right.
This was the entire requirement of Ind AS 112, which is talking about a disclosure requirement in your SFS. Over to you, Ashish sir.
Okay, right, sir. Sir, my next question is to Ravikant, sir.
Yes, sir.
Okay. Sir, would an investment in a partnership firm where an entity holds more than 20% share be classified as an associate under accounting standard? If so, how should an investment be presented on the financial statements? Let's say, for example, in associates or another category. Additionally, when accounting for the share in profit and interest or capital is received, should this recorded be as item with other comprehensive income or directly offset against the investment of carrying amount?
Yeah. See, sir, the accounting standard you are asking with respect to standard AS, right? Am I?
Yes, sir.
Correct. So when I say accounting standards, first, basically, accounting standards are applicable for every entity. Right. So if you read the language of accounting standard 23, it very clearly says investment in entity, that the word is entity is used, which is a broader. I mean, it can be a firm, it can be LLP, it can be a company, it can be any firm.
Okay.
Right. So whether investment, like the point, what you need to analyze, do we have significant influence or not? If you have significant influence, that is power to participate in the financial and operating policies of the associate and another entity, then that entity is going to become your associate. So whether it is a partnership firm or whether it is a LLP, answer is going to be based on power to participation.
Okay.
Right. That is one point. And the next question, can you please repeat?
Sir, the next question, additionally, when accounting for the share in profit and interest on capital received, should this be recorded as other comprehensive item or directly offset with the investment in carrying amount?
See, when you use the word other comprehensive income, that means I understand the question is from the perspective of Ind AS 28, not
Yes.
from accounting standard 23. Yeah. See, when you will be taking, we said so far investment, our share of, right? Let me Let me use whiteboard for a few seconds. Yeah. See, we said our share of profits. Our share of profits or losses. That is what we mentioned. Yeah. See here, when you say as per Ind AS, our share of profits in the sense that may be arising from the profit and loss statement, that may be arising even from the OCI. Say I have got an associate company. Okay, their profits, that is from the profit and loss statement, profit is equal to say 1,000 rupees is the profit, and there is some OCI element. OCI element, let me take an example of revaluation reserve. This revaluation gain is done, there is a gain, revaluation gain by the associate. Yeah, they revalued their financial, their fixed assets, I mean to say property, plant and equipment, and they got a gain of say 500 rupees, they got a gain.
Yes.
And I have got a share of 30%. That is my company. I am holding 30% in the associate company. So what do I do in this normal case? Our share is 30%. We will be recording, say, investment in associate account. We will say debit. 2. Our share of profit. Yes, our share of profit. Yeah, here some small point is the profit and loss may how much is coming? 1,000. And out of 1,000 into 30% is 300. This will go to my consolidated profit and loss statement. And 2, OCI statement. OCI may 500 into 30% is equal to 150 rupees. This will be presented in the OCI statement.
Yes.
I mean to say profit and loss statement may profit and loss may our share of profit 100 rupees. Below under OCI, yeah, our share of revaluation reserve arising from our share of profits from the, I mean, revaluation reserve of associate, we will mention there, that is going to become 150. The total number 450 rupees is going to be added to the investment in associate company.
Okay, sir.
Like this OCI, I mean, if my associate is showing in the profit and loss, that profit, that will come in my consolidated also profit and loss.
Right,
if
sir.
my associate is showing it in the OCI element, then my share of that OCI will come into my consolidated profit, my consolidated OCI. Exactly.
Right, sir. Right. So my next question is to Bhavesh, sir.
Yes.
Sir, if an entity's investment in partnership firm is less than 20%, but the majority of purchases are made from the partnership firm by a private limited company, should they still be classified under associate under the accounting standard? In such scenario, does the Ind AS apply to the financial reporting of these entities? And how should the interest and profit derived from the partnership firm will be accounted for in the financial statements of the private limited company? So it's like basically a influence kind of the company is having influence, right? The most of the purchases.
Yes, sir. See, as you have told about that a partnership is having a share of profit less than 20%, no?
Yes.
Okay.
Private limited company is having 20 share of 20%. Let's say 15%.
Okay, less than 20%
yes.
is in the question, no? But see, you have told one more thing, that a majority of purchases.
Yes.
Majority of purchases, in that you use the word control and influence are there.
Exactly.
So when control and influence are there, so that would be a part of an associate.
Yes.
So in the first question also we have elaborated that less than 20%. Less than 20% sometimes also demonstrate that you are an associate.
Yes.
You are an associate, provided you have a significant influence. So here you are telling control or influence is there, but the holding is less than 20%. So we may go at that, yes, the connectivity is between one to other organization is an associate.
Right.
And when you form an associate, we have to follow our normal Ind AS and all the accounting requirement would continue.
So again, how should the interest and profit derived from the partnership firm be accounted for in the financial statements of a private limited company?
Yes, in the similar pattern as we used to follow at the time when we have a relationship of an associate.
Right. So the profit, let's say interest income, it will be credited in profit and loss account, and the second impact will be in the
value of investment.
Right, sir.
Value of investment. Correct.
Yeah. Right, sir. And sir, my next question is to Ravikant sir. Sir, is it necessary to establish a new legal entity with a distinct PAN for joint operations, or it can be based solely on a verbal agreement and a cooperation between the two parties involved? If a verbal agreement suffix for joint operation, what is the appropriate method to record the receipts from the operation in the financial statement? Secondly, should they be reported with other comprehensive items treated as a return from investment or offset against the cost of investments?
Okay, see, when I think this is the question from the Ind AS perspective. Am I right?
Yes, sir. Yes.
Yeah. See, when you say joint arrangement under Ind AS 111, first thing we will ask, do you have a legal entity concept first? We are talking about something, do you have legal entity?
Right.
Yeah. So the answer can be what? Answer can be yes, also, no, also, both are going. That's all. No, suppose example, if you say I don't have a separate legal entity concept, I mean, that is not a separate legal entity. Then you don't need to think too much about it. No, it is going to be a joint operation. JO, I'm going to close it.
Yes, yes.
Suppose if you say no, sir, there is a legal entity. Okay, we have formed a company or LLP, a separate legal entity. Okay, under that circumstance, now you are supposed to look at the terms and conditions. Okay, what is that? What is the rights and obligations? Basically, the rights and obligations related to the, venturers, operators, right? Whether the rights and obligations of these people with respect to the specific assets, yeah, is it with respect to specific assets and liabilities? Then it is going to be joint operation. No, it is with respect to net assets. It is not with respect to specific asset. When it is a net assets, then only it is going to be classified as joint venture. We are going to classify like this. It is going to be judged. It is not based on. See, there is no straight answer like based on the PAN, or we can't answer like that. You have to go by legal entity concept. At the same time, some terms and conditions of the agreement between the two parties, and with respect to rights and obligation, of the assets or liabilities, or on the net assets you are supposed to.
Right, sir. So, thank you for the answer, sir. So, my next question is to Bhavesh, sir.
Yes, sir.
So, when an entity exercises joint control over another entity, what is the recommended accounting treatment for the investment? Secondly, should it be disclosed already in the notes to accounts of the financial statement, or should it be recognized as investment in associates under a different accounting category?
Yes. So now your question is coming, I hope, on the joint control over the another entity. See, whenever there is a joint control, earlier I shared a definition of the joint control, wherein we have collective and the unanimous decisions. But here now I would like to extend the joint control definition to, like, joint control we will divide into two more parts. One will be your joint operation and other will be your joint venture. Joint operation and joint venture under the shelter of joint control. So whenever you say joint operation, so under a joint operation, we have a common sharing of assets and the liabilities between the two entities. Over there, you may follow a proportionate method of accounting. But at the time when you come to the joint venture, over there you have to follow the equity method of accounting. So the disclosure and the requirements for the purpose of joint venture will go under this standard. And it would be recorded as an investment in associates and the joint venture.
Right, sir. Right.
Ashish, sir.
Okay, sir. Sir, my next question is to Ravi, sir. Sir, in the equity method, income from a joint venture is increased or decreased by the investment or disclosed in OCI?
This is, I think, like earlier answer will be suitable.
Yes, exactly.
So, I mean, if the income arising to the associate company, is it recorded in the profit and loss item, or is it related to OCI?
OCI, yes.
If associate has recorded as a profit and loss item, our share will be recorded in our profit and consolidated profit and loss of investor.
Right, sir.
If that is recorded in the like revaluation gain or foreign currency translation reserve or any remeasurement of defined obligation or any cash flow hedge related thing, right, then that those OCI items of the associate will come as it is. I mean, our share of it will come in the same line. It will come in consolidated profit and loss of investor company में आ जाएगा.
Right, sir. So this is probably the last question, sir. So I would like to, if you can both give some views, Ravi sir and Bhavesh sir, separately. So the question is, please explain the major differences between IGAAP, IFRS, and Ind AS on accounting of associates and joint ventures. For example, in case of assessing a significant potential rights, share of losses, disposals, and goodwills.
Yeah, let me take the first two things.
Yes, sir.
Right. So first two things, like it is, you are saying potential voting rights. Yeah. So I mean, potential voting rights are like convertible debentures or convertible preference shares. Say simple example, I have got say 20%, less than 20% stake, say 15% stake in an associate. As it's not an associate, another company. 15% stake I have, but I have convertible debenture. Once it is converted, as on 31st March, no, it is not converted. But once it is converted, my 15% may become 25%. Then the other company is going to become my associate. Now the question is to decide whether the other company is my associate or not. Do I need to consider potential voting rights or not? As per accounting standard 23, very clearly it is said such potential voting rights are not going to be considered to determine the significant influence. But Ind AS 28 very clearly says, yes, you are supposed to take the potential voting rights also to determine the significant influence. I mean, but subject to one condition. There are two conditions basically. If you want to consider potential voting rights, first thing, I should be having an option to exercise on the balance sheet date. Suppose it may be convertible after a year or some time. No, then that will not be taken into account. I mean, I'm the investor. If I wish, right, I want to exercise the option and I want to get the equity share, that right should be there as on 31st March. Point number one. And
Right.
point number two is what is the economic interest? Can we do it? Correct. See, I have a voting right, but the offer price is too high. Compared to market value, it is too high. And see, it is not a small thing like what I am buying. It is like 20%, 30% is the wish to continue and get the gains and losses, I mean, gains of the other company for long term. So what is my, what is my objective basically? Objective you are supposed to look at. So if I purchase it, is it going to give me some economic interest? Yes. If it is beneficial to me, if it is in the money in another angle, if I say, then we are going to take the potential voting rights into account. And can you repeat the second point, sir?
So share of losses.
Share of losses. In case of accounting standard 23, we will be taking the share of losses till my investment in associate amount becomes zero. Right. But in case of Ind AS 28, not just investment in associate, you are supposed to consider investment in preference shares of associate, investment in long-term debentures, debentures and long-term loans and advances. All long-term elements you are supposed to take it. Till your investment in all these things become zero, you are supposed to take the share of losses of the associate. And when subsequently, if your associate is reviving, example, if you subsequently your associate is reviving, then in this reverse angle, first you will be cutting from the investment in equity, next you will be cutting it from the investment in preference shares, next you will be cutting it from the debentures or something. Now when the profit comes, you start recognizing from the last one what you have deducted. It will be going back. It will be, you will be recognizing investment in loans and advance, investment in debenture, investment in preference share, last May investment in equity share is going to come back when subsequently associates started making profits. Yes, sir. Over to.
Right, sir. Sir, over to Bhavesh, sir.
Bhavesh.
Sir, Next 2 points are the disposals and the goodwill.
Okay. See, now in context to the goodwill, there is no much differences there between disposal. Coming toward the major part about the goodwill, like our Ravi sir has also performed a very well design on the whiteboard about explaining the goodwill part for recording in format of associate. No, in the bracket we are writing the goodwill, and it will not be written separately on the face or anywhere in the schedule. So in the bracket you are telling that this is an extra amount that we have paid over and above our cost of investment. That is the treatment that we used to follow for an accounting standard 23. Same way we follow for an Ind AS 28, but for an associate. But coming toward the joint venture under accounting standard 27, that in the bracket we will not write the goodwill, it would be written on the face of the balance sheet by eliminating the investment cost with the net assets appearing on the date of acquisition. But the same way it will not be followed under the Ind AS. Under the Ind AS, we have the same treatment for associate and the joint venture, that is the equity method. In the bracket only we will write the goodwill, but it will not be eliminated, same as like your joint venture under accounting standard 27. That is a major presentation, and the treatment, accounting treatment distinguish would arise amongst the associates and the joint venture as you have highlighted. Over to you, sir.
Okay, so sir, our questions are over, but we have some live questions coming from
Okay.
the audience, and I would like if any one of you, sir, Ravi sir or Bhavesh sir, please, if you can throw some light. The first question from the audience is, please clarify the counting for contribution of non-financial assets in JV. Ravi sir or Bhavesh sir, any one of you, if you can throw some your opinion or throw some light on that.
No,
Give
is
your
it like a contribution between the joint venture and venturer? I mean, is it like you are giving a property, plant and equipment by the venturer to venture? Is that you mean?
Probably yes, sir.
No, then that is covered by already Bhavesh sir.
Right. So
Maybe this question before that point.
That we have covered by way of an example, I hope so.
Yes, sir.
Yes, sir.
Profit, loss, everything.
Contribution by a joint operator in the joint venture.
Yes, sir.
Contribution of an asset or a sale of asset or a sale of goods by a joint operator in the joint venture, then they will record, if it is a profit or a loss, then they will account for the share of other entities' interest in their books of accounts.
Right, sir. So the next question is, please throw some light on the deferred taxes in investment in joint ventures.
Yeah, let me take it up. See, in case of accounting standard with respect to consolidation, especially in case of consolidation, there is a clarification by ICAI. Consolidation, you prefer the group entity. It's for a group. It is not for a assessee. Assessee will become the respective entity, like holding separately and separate one legal assessee. Subsidiary is a separate legal assessee. Everybody is sub-assessee. But when you are preparing for the group financial statement, that is consolidated financial statement, you don't need to recalculate the deferred taxes. This is from accounting standard angle. You will be just taking whether let it be a deferred tax asset sitting in the joint venture or deferred tax liability sitting in the joint venture. We will be taking like our share of our proportionate share. Say I have 30% is 30% of DTA, 30% of DTL, like another asset. It will come and sit in the consolidated financial statements with respect to accounting standard, I am saying.
Right.
But if it is Ind AS, as we follow equity method, there are few, I mean, 2-3 specific paragraphs with respect to investment in joint venture, investment in associate. Yeah, see, we are taking our share of profits or losses, correct? But when you sell the investment, what will be allowed by the department? I mean, in the consolidated balance sheet, I will be, say, example, I bought it for 100 rupees. Because of the subsequent profits or subsequent share in profits, it has become 150 rupees today. Tomorrow, if I sell it, I will be realizing, assume I will be realizing 150 rupees. But department is going to give me, income tax department will give me what is my cost. Cost will be 100 rupees. and they will say 50 rupees is capital gain that is taxable. That's why this 50 addition is happening only in the consolidated balance sheet. Consolidated balance sheet. That's why deferred tax liability should be created in the consolidated balance sheet. There is one more exemption is there. If we control the dividends and etc., then you don't need to make it. But that exemption is not applicable to joint venture and associate. That is applicable only with respect to holding and subsidiary relationship. I thought we can say when we want money, I can get it from the subsidiary. When I don't want, because I have a control, I can say you release the funds means they will release it. Correct.
Yes.
But in case of associate and joint venture, you have a joint control but not control. And in case of associate, significant influence, there is no control, there is no joint control. There you need to create deferred tax asset or deferred tax liability arising because of the subsequent profits or losses accounting as per equity method.
Right, sir. So the next question from the audience is, what are the requirements of consolidations of financial statements for JVs and associates?
Yes, sir. I will take care of this question. See, at the time when we follow the consolidation of financial statement, when you have a JV as an investment, associate as an investment. See, for the purpose of Ind AS 28, we have to follow the equity method of accounting for consolidation purpose. But if you are under the accounting standard, then for the associate, there will be an equity method of accounting. But for the joint venture, there will be a proportionate method of accounting that would be under accounting standard 27 for joint venture. But for associate, AS 23, equity method of accounting. While going through the Ind AS, it would be same equity method of accounting for both associates and the joint venture for the purpose of consolidation.
Right, sir. So I guess the questions are over, and I don't find any more question from this side. So let me state that, sir, the recording of this webinar will be available in few days on ICI TV and the YouTube channels of ICI. All right, sir. And let's say, Shalin ma'am, everything is, I guess, over. If you are left with any question, can you please take over?
Thank you, Ashish ji. Thanks for wonderfully moderating the sessions. And I would really thank on behalf of ASB to our learned speakers who have been very thorough with their subjects and wonderfully depicted everything on the screen in such a less time, and in that too in a very interactive way.
Yes.
And we are getting a lot of responses from the participants that they are enjoying the session. And in absentia, I would like to thank my chairman ASB and vice chairman ASB for giving us this opportunity to organize these kind of programs for our members as well as for other stakeholders, who at least get to know what we are talking about. We are not only teaching the Indian accounting standards, we are covering the accounting standards, what all the practical challenges as an auditor, as an accountant we are facing in day-to-day recording of the books. So with all the support of all our learned faculties and members like you, Ashish ji, we are able to deliver what we have taken care of with the under the able guidance of our chairman and vice chairman. And ICI has always been upfront in taking up the initiatives for upgrading the knowledge of the fellow members and other stakeholders. We look forward to have you again in the next very interesting and informative session, and on very important and relevant session of something related to accounting of other kind of entities. So with this, I would like to thank each and everyone for participating and deliberating so well. On behalf of ASB, we thank you all and look forward to have you in our next session. Thank you all.
Thank you, ma'am. Thank you, ma'am.
Thank you.